Excellent. Well, welcome to the Crypto Policy. Welcome to the Crypto Policy Symposium. I'm Siddharth Venkataramakrishnan, or Sid, the FT's banking fintech correspondent, and I'm delighted to be hosting this panel on Contagion, crypto economics, and the financial system. We have an all-star panel today, including, that note's gone, sorry, Carol Alexander, Professor of Finance at the University of Sussex, independent journalist Amy Castor, and author Francis Coppola. We've seen crypto move from being a supposedly cypherpunk libertarian ideal on the fringes of money to ape, pun intended, and increasingly work like the status quo. In the panel, we're going to look into the weeds of what that means for financial stability, as well as for retail investors who are increasingly at risk of being entangled in crypto changes around the world. So the first theme we really wanted to touch on, Amy, was really looking around how crypto has grown to really resemble conventional finance and some of the ways in which it's really, fundamentally come to resemble the worst parts, actually. And, stablecoins are something that we've talked about in the past, previously Tether, but obviously Terra and Luna have really blown up and really taken the headlines. So I wonder if we could start off there from your perspective.
Sure, Sid. So the thing is all of crypto, and Francis has said this before, is essentially a US dollar derivative. If you look at Bitcoin, it's now valued at about $20,000 today, one Bitcoin. So its value is in USD, right? It's not one Bitcoin, it's $20,000. Because of most of the exchanges, the largest part of crypto trading happens on offshore unregulated exchanges. They don't have access to traditional banking, so they need sort of a stand-in for the US dollar so that traders can exit in and out of volatile positions, can move their money around, their funds around more easily. So stable coins came about, and they really started to proliferate in 2017 after one unregulated exchange essentially became insolvent after a hack. And that exchange, also the same people that ran that exchange ran the company Tether that issues a stable coin of the same name, Tether. And so we saw a lot of Tethers being issued then, and that correlated with a rise in price in 2017 of Bitcoin. There are now, I want to say, 170 billion stable coins out there. And the biggest ones would be Tether. There are now about 67 billion Tethers. It's now also has a large competitor known as USDC, which is put out by essentially a company called Circle in the US. And there's about 57,000 USDC coins out there now. And we also had an algorithmic stable coin, which was USD, Terra USD, and that collapsed spectacularly in May. The problem with these stable coins, Sid, is that none of them have really had a full audit. There have been attestations or snapshots of these stable coins, but nobody is really sure what's backing them. Most of them, like Tether and USDC, are issued as an IOU, so that, for example, the idea is that for every Tether you own, there should be $1 put away in some bank account somewhere, or a dollar equivalent. But it's really hard to know what's going on. And Tether has fibbed quite a bit in the past about what's really backing Tether. So there's a big question about what would happen if everybody who had stable coins tried to go and get their dollars back. So that's sort of the role that stable coins play.
I was going to say, I think Francis, we discussed previously Circle, well, Coinbase at least, and Circle, when they were talking about USDC, the second largest stablecoin, seemed to have slightly different stories at one point on what was backing it. And I think now that's been straightened out, but for a time that was a case, I think, if I remember that correctly.
I think it's been true of all stablecoins, is that what they've claimed to have backing them has turned out not to be the case. That was certainly true of Tether for a long time, but also, as you said, also of USDC. They do seem to have been producing more detailed and more transparent attestations, and that's a good thing. There are some questions, I think, about that link between stablecoins and the real financial economy, because what they're backing these stablecoins with is real financial assets in traditional finance, things like US Treasuries. And so there are questions about when you have a very, very big stablecoin like Tether, billions and billions of it, that is billions and billions of real world financial assets backing it, which, if there were to be a run on it, there would suddenly be a run on those assets in the real world, and that could have systemic consequences in the traditional financial system as well.
If people with Tether could get their funds back, I'm not sure that Tether is really obligated to give them their funds back. I mean, there's only about 10 large Tether customers, and they are able to redeem Tethers, but all the people that have, the secondary customers of Tethers, the everyday traders, I think it would be maybe next to impossible for them to redeem Tethers.
I think if there were a run on Tether, it would actually play out through the exchanges. And we would see a lot of exchanges suspending trading in pairs involving Tether, as indeed we have seen, or even going down for maintenance. The close for maintenance thing for exchanges is extraordinarily coincidental, shall we say. It always seems to happen whenever there's some kind of turbulence in the crypto markets. And I think lots of us now think, yeah, close for maintenance. You are running out of liquidity, aren't you? And then they reopen a few days later when they've topped up their liquidity. And we've seen that play out again and again. And I think if there were a run on a major stablecoin, that is how it would play out. So that may be less concerning for the financial system, the traditional financial system, than actual run on something like Tether. It's not quite as clear what the redemption arrangements for Circle for USDC would be, I think.
Or even with Tether, I just wanted to say that what you might see if there was a problem with Tether is that on the unregulated exchanges, what people would do would be they would be trying to buy up assets like Bitcoin as quickly as possible. So Bitcoin, you might see a rise in price of Bitcoin on unregulated exchanges if people try to dump their Tether with Bitcoin or Ether and then move them to exchanges like Coinbase, where they can exit into US dollars.
That's true.
By selling their Bitcoin,
yeah. But you also, it's actually hard to work out what would happen to assets like Bitcoin. Because on the one hand, you might say, yeah, people might dump Tether for Bitcoin. But on the other hand, you might find that exchanges trying to find liquidity are having to sell Bitcoin in order to raise funds, particularly if there is a flight to US dollars, which is actually what we saw after the collapse of UST, was that Tether unpegged, and there was a flight from assets like Bitcoin and from Tether into US dollar equivalents, into USDC, and even into US dollars themselves. And if that were to play out, then you would expect to see Bitcoin's price fall, as indeed it did after UST collapsed.
Can I say something here?
Yes, please.
Yeah, there are other types of stable coins, of course. There are the algorithmic ones that didn't work very well, like Terra Luna. But then DAI by Maker is the original stable coin, which is on the DeFi. And everything you've been discussing, I have no argument with at all. I agree with everything that you're saying, but it is just CeFi. And what's happening on DeFi is, it can spill over into CeFi, for example. That's exactly what happened with the Terra Luna attack. But when we look at, like, as I said, DAI is the original stablecoin. It's also the largest of the algorithmic stablecoins, and it is, very much on chain. It's only 7 billion in market cap, whereas USDC is 52 billion, or a bit more than that. And as you said, Tether's over 67 billion. And then the Binance stablecoin as well is rising, particularly the Circle coin and the Binance coin. I mean, Tether's actually 12 months ago, it had the same market cap as it has now, whereas USDC has been rising all the time, Binance has been rising all the time. And so, but anyway, going back to the DeFi side of things, you know, these are fully over collateralized actually, in order to get a DAI, and that works the opposite way. People who actually are crypto rich but cash poor would use their crypto. It used to be just Ether, but now it's any crypto that you can use to put into the maker pool, and you can take out the DAI, and then you can spend it on any, you know, wherever you want. On the DeFi platforms, you can earn yields, you can use staking as a service, and so but the problem with that design, there's always problems. Obviously, we saw the problem with the liquidity pool manipulation with the Terra Luna problem, but also it's very pro-cyclical because Maker needs to have a certain amount of collateral. They need to be over collateralized, and so if the price of Ether, or if they take other crypto, if that falls, then they have to liquidate these certificates for deposit that the collateralized debt positions that people have taken in Maker, and so they're going to be selling more crypto. So I don't like that design either, because it's a very pro-cyclical thing where, you know, if crypto falls, then you get mass liquidations by these stable coins, which will make them fall even further. So as far as I can tell, there's nothing good about either the supposedly fully collateralized ones or the over collateralized non-custodial ones. But the nice thing about the non-custodial ones is that at least they're not run by just a few people in a company. I mean, it's very decentralized. There's a big network that votes on things and so forth, which is rather nice.
That's true, though, of course, with DAI, quite a high proportion of collateral is USDC. And in fact, one of the interesting developments in that space has been the growing use of USDC, particularly as safe collateral, rather akin to USTs. And DAI is one of the particular areas where it's used a lot. So there is that link to CeFi, even with something like DAI.
Yeah, good point. Yeah. And I wonder where Sid is, because I can't see him.
Hey, ladies, we're on our own.
But luckily he did send his questions in advance in an email. So shall I have a look?
I think one of the other questions was about crypto exchanges and the behavior of exchanges, right? And
the centralized exchanges, not the DEXs. Yeah.
The one point I want to make about the crypto is that you can think of it, all of crypto is sort of modeled as a single integrated casino. It's not at all like an industry of competitors. The US dollar exchanges like Coinbase and Gemini, they're more like the cashier's desk, and the real action happens on the unregulated floating offshore tables like Binance. So that's something I wanted to point out. You can regulate Coinbase, but you can't regulate Binance so easily, you know?
But I mean, on that point, I mean, I totally agree. I also think Bitcoin is a useless, purely speculative asset that, well, not even an asset. It's just a speculative vehicle. It has no intrinsic value whatsoever. But on the DeFi side, where S is the currency, you know, there's a lot of innovation, a lot of really, I mean, the whole of Web 3.0 is coming up there. So that, but nevertheless, the DEXs are just as bad because, you know, you can manipulate them just as easily as the rogue Wall Street traders manipulate Bitcoin by, you know, fueling it with Tether and taking massively leveraged positions. But you can manipulate liquidity on the curve pool, as we saw. So, you know, they're all open to terrible.
I think Sid is back. But
Yes,
the
yes,
the the thing
Apologies.
with the DeFi exchanges, Carol, is that I think that it was very difficult for most of the public, most retailers, to really understand how they work. You'd have to, it was a little bit too intricate, and the blockchain, you'd have to get into all that. So what really came up, what really started to catch on, was the centralized finance, where you could easily go onto a platform like Celsius and give them your Bitcoin or USDC or whatever it was, and they would promise high returns, and they would just mysteriously invest it in these DeFi platforms on your behalf.
Celsius was DeFi as well. I mean, it's
Yes,
all
well,
chain. It's
it
all
was
crypto-only.
organized by, it was a centralized organization, but they were betting on the DeFi, so all the money, and that's sort of what happened when everything started to go downhill and the house of cards started to fall apart in May after the UST crashed.
The way I distinguish the sort of on-chain, off-chain, centralized,
Mhm.
decentralized is that, you have these centralized places, like also in the NFT space, like OpenSea and so forth. These marketplaces are almost like the malls or the petrol stations, or, they're off the motorways. And then decentralized is on-chain. So everything is recorded, and it's on a blockchain, which means it's crypto only, obviously. But I mean, these CeFi exchanges that you were mentioning, a lot of them are just pure crypto. Coinbase, FTX, and others are fiat exchanges as well, Kraken too. But the reason why stablecoins have become so popular is that you can actually use those exchanges as a broker for fiat, although these activities have been frowned on by the FCA and various others, trying to stop people using these self-regulated exchanges as a broker. But you can't take them off. As you mentioned, your Coinbase is the cashier's desk of the casino, because if you want to get back into fiat, you have to go somewhere like that. But you can actually onboard fiat. And it won't be recorded on the blockchain. It's only when you onboard the crypto that it's on the blockchain, of course.
Apologies for dropping out earlier. My computer decided it just wanted to stop working. Absolutely, it's full charge, but no desire. But it sounds, I was going to say, have we touched briefly on the idea of, it sounds like we've been talking about the concentrations of power and centralization as well as DeFi. I don't know if there's anything further worth adding, because otherwise I was going to sort of turn.
Other than the whole idea of decentralization is generally a myth. There's always a central party controlling something, either the software development or whatever it is, but there's always a central party that maintains power. So there are still intermediaries. We just don't always know who they are.
Well, as you were saying, the Celsius is centralized in that sense. I mean, it's just a definition of what is centralized, what is CeFi and what is DeFi. But as you say, all these organizations in the DeFi space are actually highly centralized.
Yeah, I mean, one of the interesting things is actually the way in which language is used to hide, to conceal what is really going on. So I'm on a mission to point out that a staking service is a deposit taking service. And what you're actually doing is making a time deposit and getting a certificate of deposit, which may be tradable. And when I put it like that, people say, well, we've had those forever. So yeah, it's actually the same thing. It may be subtle tweaks, but under a different name. And so you call it nothing like finance. And from where yes, it is. It's exactly what traditional finance has always done. Some deposit taking, deposit, goldsmiths receipts, whatever, and again down the centuries, and letting off the back.
You were cutting out a little bit there, Francis. We didn't get everything that you said, unfortunately.
You appear to have frozen as well.
Some contagion in our machines.
So I just want to add that, so when you think about decentralized finance and that word decentralized, it's really just an attempt to put traditional financial systems, transactions like loans, deposits, margin trading on the blockchain, and the regulated institutions are replaced with unknown and unregulated intermediaries. Everything is facilitated with these smart contracts that exist on the blockchain.
Well, I was going to go to Frances for the next question. Oh, she's dropped out. Well, maybe we go back to sort of swap themes around slightly and talk actually just about the risk of contagion and sort of the topic itself. Oh,
yeah.
Okay, well, or Frances is back and we can do it in the order you suggested, but
my apologies, my internet connection dropped.
No problem at all. Well, then I'll swap back the original order and talk then on that theme, sort of linking into what you're saying around sort of issues of misselling and the entanglement between crypto and conventional finance, and particularly on the retail side, what we've seen. If you'd like to kick us off on, so obviously pensions is one area where a particular concern, I think.
Yeah, well, not just pensions, but retail deposits. Where when my internet connection dropped, what I was saying was the way in which crypto and DeFi in particular actually uses language to conceal what is really going on. So staking services, for example, are time deposits with a certificate of deposit attached, as Carol said, which may be tradable. They don't call it that. And the moment I describe it like that, people say, we've had those for centuries. Yeah, absolutely we have. And off the back of that, they can be lending too, but somehow the lending isn't called lending either. And it's somehow morphed into something else. And so it's not surprising really when you're getting this kind of confusion over language and this representation of something that is as old as the hills. It's deposit taking and lending, which is the business model of a bank. But somehow it's not that anymore. It's not a bank. We're not a bank. Celsius actually said we're not a bank. It actually specifically said it. And I looked in and went, yeah, well, you're quacking like one and waddling like one. So in my book, you're a bank. But it's understandable faced with that and with the reputation the banks have, that retail customers might say these are not banks. They're better than banks. They're safer than banks. Celsius actually marketed itself as a safer alternative than banks. It was actually considerably riskier. It didn't have the deposit insurance. It didn't have the Fed backing. It didn't have the regulation. It didn't have any protections for customers. And there was no transparency over what it was doing with their funds. And the over-collateralization that it was marketing to its customers, saying, oh, our lending is completely safe, it's all over-collateralized, turned out to be a lie. And there is no protection for retail customers from, frankly, what is a shark pool.
Well, what Celsius did have going for it was Alex Mashinsky, who was a wonderful salesman.
Yeah.
And he convinced a lot of people to hand their money over to him. What he was terrible at was investing. He made some terrible, bad investments. And he promised something like 18% returns on their money, which is frankly pretty questionable how he was coming up with that. And
towards the end, he was actually running a Ponzi scheme. That's actually in his court filing. And there have been rather a lot of Ponzi schemes in the CeFi and DeFi space, simply because it's so easy to do. So you can promise people insane returns. You can tell that you can market it to something. God, this isn't a bank, is it? This is much better than a bank. You can get better interest rates and it's safe. And what you're actually doing is recruiting new people to pay the returns you've promised to your existing ones, and that's a Ponzi scheme. And there's been a lot of those.
And it works until too many people want to take their money out at one time.
Yeah, absolutely. And I know that the argument is that actually traditional banking is a Ponzi scheme in that respect, because it's fractionally reserved, that banks don't have liquid assets sufficient to enable people to pull out all of their deposits at one go. But the difference is that traditional banks they have capital regulations, they do have liquidity requirements, but they have access to central banks and they have deposit insurance schemes. And these crypto banks, these crypto shadow banks, which is what they actually are, have no such protections. So they're actually much riskier for retail lenders, for retail depositors, than traditional banks are. I'm part of me says, yeah, well, you know, it's high returns. You really should be on your guard. There is no such thing as free lunch. If something's offering 18% when banks are offering less than 1%, there's something kind of not quite right here. But it's understandable that retail people who don't understand the way this is being marketed will simply say that, yeah, this is good. Give me the returns.
Mhm.
Do you have, I mean, I end up touching on the cost of living crisis quite a lot now in my work, and it feels like that probably amplifies a lot of these concerns and the need, especially as you say, when banks aren't passing on full rate of interest rate rises, then it seems that the pressure for people to find ways to maximize money is only intensified.
Yeah, it's wholly understandable. And then this is exactly the reason why we have regulation, why we need protection, not just about the way banks conduct themselves. So we have conduct regulation as well as prudential regulation, but also the old-fashioned kind of trading standards, protections against misselling and advertising fraud and things like that. This is kind of completely missing in the crypto space. There've been some half-hearted attempts in some countries to clamp down on some. I mean, the UK regulator, Advertising Standards Authority, for example, clamped down on advertising of crypto schemes on buses and tube trains, for example. But we have not seen the kind of regulation of these products in terms of how they are sold to retail people that is needed.
Mm-hmm.
That's because people don't understand them enough.
Absolutely. The regulators don't understand them enough. I think that's a lot of the problem.
That is the big problem.
And it was sad with Celsius and Voyager, both were CeFi platforms. Both are now have filed for Chapter 11 bankruptcy, and you know, that promise of easy money, you know, high returns is very seductive to people. You know, it's very alluring, you know, I mean,
and there are a lot of people out there. I mean, when you look at the size of the loan, and Voyager got taken down by Three Arrows Capital, but that their loan was $670 million.
A single loan took them out, basically.
And when you think about the 2017 crash, you were talking about, you know, the tether-fueled pump and dump, basically a massive one that happened in 2017, 18, beginning of 2018, I think it was that happened. That crash, the entire market cap was about 670 million. And what is the market cap now? Well, the derivatives trading, there's 2/3 of the trading volume is on derivatives, on centralized exchanges. And I was just looking the other day, I think it's 3 trillion is the market cap of derivatives exchanges. That's 2/3, and the spot is obviously about 2 trillion or something like that, or a bit less. But the size of the market is growing all the time, and particularly since the beginning of 2021. So, you know, that's less than 2 years ago is when it really started exploding. So there's
what's that, Carol, the DeFi market or the CeFi?
This is CeFi. DeFi is the next big thing, and that's growing all the time.
Yeah, I think it was hard for most people to understand DeFi. So CeFi came along and said, hey, we'll take your money and we'll put it into DeFi for you, and you can just have 18% returns. You don't even have to do anything.
Very, very risky. And, you know, then there's that sort of infinite money tree that's what Three Arrows was trying to you know, the relationship between places like Lido, the staking as a service, which is really still taking off. You know, I was just looking at that recently, because as Frances, she was saying, there's this they call it a collateralized debt position, but it is just a certificate for deposit. So you put in your S as staking as a service, because you haven't got 32S. You need 32S to be a staker on the new Ethereum chain, right? Now, when it comes to the merge, which has been delayed, that means that Ethereum is going to transition to proof of stake. And we've been running this beacon chain for quite a long time. At the moment, there's about more than 10% of all the S is locked up on that beacon chain already. as big people staking, but also Lido allow little people to come along and get the staking rewards. And at one point, the staking reward, this was before the 3 Arrows event, 3 Arrows were getting something like, in double figures anyway, the staking was more than 10%, the yield on that. Now it's only like 4%, because the more S that goes on to be staked, the less the personal, you know, it's a bit like proof of work. The less chance you have to win the next block, so you get less yield when more and more people are staking, right? So this is the Lido, and others, Binance are doing it. There's BES instead of ST, staked S. And they're supposed to, they're not stable coins, but they're like stable coins. Stable coins like Tether and USDC are really, as you were saying, Amy, at the beginning, it's just a sort of Bitcoin equivalent of the dollar, really. It just allows dollars to be put into Bitcoin and then Bitcoin to be speculated. But on the DeFi space, where S is the currency, this is what's coming in the future. And so what you're doing is putting S into STS 1-for-1, you hope, or into BES 1-for-1. And so you put a small amount, if you like, of S, and it doesn't have to be S, it can be other crypto now, it used to be just S, onto Lido. You get your staked S, and then Lido will change it all into S and stake it on the chain for you, because you have to have at least 32 to be able to do it. And then you take that staked S, and then you can put it into Celsius or Voyager, and you can get the 18% return or whatever it is that, or you can use it as collateral to get more S, and then you can go around, and that's what I meant by the infinite money tree, and you're getting interest both sides. Yeah. That's what 3 Arrows Capital were doing, as well as buying an awful lot of Luna tokens. And then they got hit by the bomb, but the bomb came from TradFi. It was like it wasn't actually the contagion from crypto into traditional finance. It was the other way around. Anyway, sorry, I went on a bit.
Well, no, you sort of preempted our next section on Contagion, and I think it's a nice, interesting way into it to talk about.
To say about the other stuff as well, though.
Yes, Carol, tell us more. Tell us more about the bomb.
The bomb.
Yeah.
Well, okay, so I mean, it was very, very like the sort of, I'm not saying it was intentional, but if you look back to what happened in 2007 and 8, we all know that the problem is the low interest rate environment. Alan Greenspan's regime just went on and on and on, forcing banks to look elsewhere, mortgages to people who couldn't afford them, etc. We all know this story. And then those mortgages were bundled up into collateralized tranches, right? So we had this collateralized debt obligations, which were tranched, and the last 100 to default would be safe, AAA rated, blah, 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 sold on by actually colluding. I mean, you've obviously watched The Big Short, you know what was happening with the rating agencies. And the bomb was that these collateralized debt obligations were transported to the European economy, and it was basically a bomb from the US to the European economy. Because before that point, the European economy was growing very, very nicely and was really challenging the size of the GDP of the US. Whereas, you know, now it's China, of course, that is. But so, I mean, it's decimated the European economy because of what it did to banks, and, you know, that was a bomb from the US to Europe, in my view. And the pigs in particular, you know, Portugal, Italy, Greece and so forth have got, those countries have been totally damaged. Anyway, it wasn't intentional, it just was inadvertent. And exactly the same thing happened with the Terra Luna. Obviously, some clever people in a very large hedge fund put a large position in Wall Street. I mean, the professional traders on Wall Street are really running riot on these exchanges, and also into DeFi. They're now getting into the liquidity pools, you see. And so, because that's a different type of trading. The CeFi, the centralized exchanges, they run order books, you know, they have limit order books, bid-ask spreads, market makers, you know, people understand that. But on the DeFi, it's done with a liquidity pool. It's an automated market maker. And the more liquidity that you have of a particular thing like Luna against, for example, Aave, if you've got more liquidity than, a lot of liquidity, then you'll get a lower price. And if you've got little liquidity, you'll get a higher price. And as the liquidity changes, the prices change. That's what the automated market maker works at. There's no bid-ask spread and that sort of thing. It's all done automatically by algorithms. Anyway, so this very smart professional trader realized that all they needed to do was put a big short position on a centralized exchange on Luna, and then take liquidity out. So these unidentified wallets, which were almost certainly the same people that put on the large shorts on Luna, withdrew a lot of liquidity from Terra in the Curve pool, right?
Yeah.
And the Curve pools also had a lot of problems. They just had more than $500 million stolen a couple of weeks ago from the Curve pool. So they've gone right down, and Uniswap is now the biggest pool. But anyway, there were several attacks on this. To Terra, liquidity was taken. So the price of Terra went right up. But the Terra Luna, this algorithm, the Earth and the Moon, if the Terra price goes down, then the Luna price will go up. And if the Terra price goes up, which is exactly what happened because of the liquidity, the Luna price will go down. And they realized this, and that's how they made a lot of money. But Three Arrows Capital were caught in it because they were bullish and long on Luna.
And that rebounded back to Voyager and Celsius. One of the things that struck me about looking at Voyager was how extraordinarily concentrated its balance sheet was. I mean, it's not just they had this big loan to Three Arrows, but they effectively only had 7 borrowers. It was extraordinary. That was it. And we think two of them were actually Three Arrows. So it was the most extraordinary piece of balance sheet concentration I've ever seen. And yet it was all funded by lots and lots and lots of retail depositors, small depositors,
Exactly.
who were being misled into thinking that their funds were safe. FTIC got involved eventually, but far too late, because a few people pointed out, the Wall Street Journal pointed it out, that Voyager had been selling deposits as FTIC insured, or giving the impression that deposits on its platform were FTIC insured when they weren't. Now, it turned out that they weren't the only CeFi platform doing this, or even the only exchange, and there were exchanges doing this as well. So there are now 5 cease and desist orders issued against a variety of platforms and one big exchange for mis-selling using FTIC as the hook to trawl in retail investors. It's just wrong. FTIC insurance does not apply to crypto, and in most cases it won't apply even to US dollar balances held in underlying banks either. The rules for pass-through insurance are really very strict, and at the moment I had a look at this a while ago and concluded there was maybe one exchange that possibly qualified, but the majority of them don't.
Even Coinbase. Sorry.
If anybody
Coinbase
who's
doesn't.
listening, so anybody who's listening, it's kind of gets complicated and hard to follow the story, but there's this, what Francis and Carol are trying to describe in this Contagion is in that in May, there was an algorithmic stablecoin called, it was Terra Luna, that crashed spectacularly. It had about $18 billion worth of value, which of course there wasn't really $18 billion backing it at all. It was based on a stable coin called Luna that just had value because
Terra.
it did okay.
Terra was the
right?
stable coin.
Terra.
Luna was the
Terra.
swing.
Luna was the
swing.
right? The
Yeah.
sister coin. But so
Yeah.
that fell apart, and then you had these CeFi platforms like Three Arrows Capital was heavily invested in Terra Luna, or their anchor protocol, which promised a high yield. And they would skim part of that yield off the top and then return some of the gains to the investors. So when Terra Luna went down, Three Arrows Capital went down, and then Voyager, another platform, had heavily invested in Three Arrows Capital. So they had to pause withdrawals and file for bankruptcy, and then Celsius also. So it was this, house of cards that all sort of came apart very quickly.
Babel
Yeah.
Finance as well. I mean,
Yeah.
that one doesn't get
There,
talked
and
about as much.
there were
but they were
other
involved too.
there were other exchanges too. So that's kind of what happened. There was this incestuous relationship where these platforms were investing people's money. There was no insurance on the funds. They weren't investing properly. They were taking gigantic risks by putting too much money on platforms that went down. They weren't hedging their bets. So it was, and the whole space is unregulated. So it's just been a mess. And the people that have suffered the most are the retail investors that have given money to Celsius and Voyager, for example, who didn't understand. They didn't really go through the user agreement or understand that the risks that they entered into. They just heard these great salesperson like Alex Mashinsky of Celsius telling them that, that the banks were ripping them off, and Celsius was there to, give them the real money that they deserved and all that. And so they were misled. And now, people are just, even when you read the letters in the bankruptcy filings, or you listen to the creditors meeting, people are asking over again, I don't understand. I thought that was my money. Why can't I get it back? Why is it going into the bankruptcy estate? And in the 341 meeting of Voyager, for example, the CEO was just telling them, go back and read the user agreement, go back and read the user agreement. And it was clear that people just didn't understand the risks at all.
Yeah, and it is fair to say that in both Voyager and Celsius, the actual user agreements, the legal terms and conditions did make it clear that you were lending your money to the platform, and it was not bankruptcy remote, and you didn't have any right to return of your funds. You were simply an unsecured creditor. And in the case of Celsius, that they not only were going to lend out your deposits, but they were also going to lend out any collateral you pledged against borrowing too. That was actually in the legal terms and conditions. But it's the small print, isn't it? Nobody reads the small print. What they read is the marketing material, and the marketing material was telling them something else. And that's actually what FTIC said, was that what's in your terms and conditions is not the point, it's what's in your marketing material that's the issue. Because
there weren't warnings. There weren't warnings
No.
either, Francis. There weren't the regulators that would come in and say, hey, shut this down.
Absolutely.
Although,
this is why I'm saying that FTIC and the Fed finally got involved, but too late. They got involved because they'd been alerted to what Voyager had done after the event, and then they had a look around and found some others that were doing the same thing. But they should have been on the ball before this.
And FDIC, to clarify, was that Voyager had made some claims that the funds that you put on the exchange were FDIC insured, and traders understood. Their customers understood it to mean that their funds would be FDIC insured, like if they put the money in the bank. And that wasn't the case at all. There was some cash funds in a bank, and those cash funds were FDIC insured by that bank. But all the crypto in Voyager was not protected at all.
And particularly USDC wasn't, and I think a lot of people, because USD has been promoted as this dollar equivalent. It is a safe stablecoin that's equivalent to a dollar. So from what I've seen, there were people who genuinely thought that their USDC was FDIC insured, and it absolutely wasn't.
And Francis, it was that they would put their cash in for the debit card, great? Voyager had a debit card,
and it was automatically converted to USDC.
Converted to a stable coin, FDIC, that the USDC stable coin, and there was no protection. And so when Voyager went bankrupt, all those funds went to the bankruptcy estate, and they became unsecured creditors. So now they have to stand in line to get their money back. And they're just sort of watching at this point while all the professionals, the financial advisors, all the lawyers in the case are now drawing out millions of dollars of their funds. And it'll probably end up being over $100 million or so before it's ended. And who knows what'll be left.
I think the misselling, and I'm going to use that term, of deposits on platforms and on exchanges as safe is actually one of the biggest issues with crypto.
Yeah.
And Coinbase too. And Coinbase
absolutely
too.
Coinbase. In fact, I looked at this recently. Well, if I can talk briefly about FTX first, because FTX was hit with a cease and desist order by FDIC after one of its managing directors said on Twitter that any funds on USD dollars on FTX were in individual bank accounts and FDIC insured, and FDIC came along and said no, they're not, remove this, and he had to take down what he'd said on Twitter and change what their marketing material said. That happened about 2 weeks ago. When we talk about Coinbase, that's another interesting development, because back in March the SEC issued a guidance note to crypto exchanges and platforms, basically telling them how they should account for customer assets on their platform, basically because the legal status of customer assets on something like Coinbase are actually quite uncertain. Certainly Coinbase themselves have actually said, we're not sure whether your crypto and even your fiat on our exchange is bankruptcy remote. It might form part of a bankruptcy. If we went down, it might be seized as part of the bankruptcy estate. And there were a few other reasons as well. So the SEC basically said, because of this, you will have to carry everybody's all your customers' assets on your own balance sheet as a liability, and you must have an equal and opposite safeguarding asset. It's called a safeguarding asset. And furthermore, that when I say it's equal and opposite, it must be equal and opposite at fair value as well. And that means that what Coinbase can't do now is say take customer assets onto its own balance sheet as a liability and then have a backing asset that is diversified into something that earns it some money, what we would call fractional reserving in banking parlance. It can't do that, because if it makes any losses at all on that safeguarding asset, it must take the loss to its own P&L straight away. So
but what does that do? What does that do, Francis? I mean, Coinbase being the largest crypto exchange in the US, I mean, so they have, reporting it differently, but I mean, how does that, what kind of protection does that offer Coinbase customers? Because the big concern was that they're going to put their crypto and their money on Coinbase and it's going to sit on the exchange. And if Coinbase went belly up, and they've been losing money hand over fist lately, and they've been laying off employees, so it is actually a concern. What would happen to their funds? And is their money going to go to pay all the bankruptcy lawyers?
Well, that is the reason for doing this, Amy.
Right, but
is that
does it offer protection? That's the point. It does.
Yeah,
okay.
Yes, it does, because what they're basically saying is that all the customers' assets are on the balance sheet as a safeguarding liability, and they must have backing that an equal safeguarding asset, and that is actually for the customers. It's not available for other things. So it's really like saying they've got to have 100% reserves. It's equivalent to 100% reserving for a bank. And the reason I mentioned the fair value side of things, because obviously, with customer assets and things like that, it's in crypto and things like that. These things, the price value of these things moves with the market, and so they've actually got to maintain the same asset profile. Because if they don't, if say they diversified the safeguarding assets into a riskier portfolio, and they then lost money on that, they would have to take that hit from their own equity. That's what this is doing. Now, the next logical step then is to look at the actual to impose prudential regulation on something like Coinbase to make sure it has a sufficient equity cushion to be able to absorb those losses. That we haven't quite got there yet. And the other thing that concerns me is that this is guidance only at the moment. It's not regulation. And
hasn't
Gensler,
I'm sorry, I didn't mean to interrupt you, but hasn't Gensler, the SEC chairman, suggested that he'd like to see those assets segregated?
Yeah, absolutely. He wants them to be bankruptcy remote, segregated, and ring
fenced. He's asked for that several times, right?
Ring fenced, in fact. Those of us who are familiar with UK banking might remember ring fencing, which was a way of protecting retail depositors from things that banks do on their own accounts. Or in America, Glass-Steagall Act, it was that kind of separation. And I know that the SEC is quite in favor of having some kind of segregation so that customers can't, so that exchanges can't commingle funds in the way that say MF Global did, whereby, you know, it's meant to be customer funds, and it's because that's another thing about, I was saying about language, that I've been kicking up quite a fuss recently about misuse of language, about, you know, people talking about, with Celsius, for example, journalists, well, Celsius themselves, but also journalists talking about assets under management. They don't have any assets under management. They've never had any. What they have is a pile of unsecured loans, which they and on their side also a pile of risky assets. But assets under management, that term means that you're looking after customers' money. The customer money is not yours, and it should be segregated. It should not be commingled with your own funds. It should be bankruptcy remote. All of those things should be in place if you're going to call it assets under management. And yet in the crypto world, they misuse that term all the time to mean things that are actually unsecured loans to a crypto platform. And your money is fully at risk, and you have no right of returning it. And it's part of this, my concern about misuse of language in the crypto world. I think we should call things what they are. These things are shadow banks. They're not asset managers. And what I think the SEC could usefully do would be to impose some kind of regulation, such as is imposed on asset managers, for example, to say, if you're dealing with customer funds, if you're an exchange, right, or you are regarding yourself as an asset manager, then you have rules about segregation and bankruptcy remoteness, and, you know, and so forth, that stop you commingling funds. So this guidance from the SEC is a step in the right direction, but to my mind, it doesn't yet have enough teeth. It is guidance only. It needs to be enforceable, and there need to be penalties for not observing it. Because as it stands, I mean, Coinbase, it would appear, is choosing to comply. So it's in its latest SEC filing, its balance sheet was 5 times the size because it had got these safeguarding assets and liabilities on it, which weren't there before. And we might expect to see some other US-based exchanges following suit. The offshore ones might not, because, you know, it's US regulation, isn't it? They don't have to comply.
Well, the offshore exchanges, sorry, Sid, the offshore exchanges, nobody knows really what's going on there. And I just wanted to bring up the story of Quadriga CX, which was one of the largest exchanges in Canada, that went belly up in early 2019, right? Because there was absolutely, even though Canada was a high trust society, there was no oversight over the exchange at all. And it turned out through later reports that it was run as a Ponzi scheme, that old investors were paid with new investors' money, and the game sort of ran up. And what we learned was that there were all kinds of shenanigans that went on behind the scenes. I mean, making up fake accounts, making up fake money, using customer commingling funds, using the funds to buy real estate, yachts, and everything like that. So you could pretty much assume that all of that funny business could just as well be happening at these offshore exchanges, because nobody's watching them. They can do whatever they want, right?
Yeah, and as it stands, with that particular guidance, even onshore ones don't have to comply. Yes,
even onshore ones don't always behave the way that they should. And I think the big fear is that we've seen quite a big collapse in the price of Bitcoin. We've seen some of these large CeFi platforms go under. They're now in bankruptcies. We don't even know what happened to the founders of Three Arrows Capital. They seem to be on the run, or they've disappeared.
Heading for Dubai last
you know, so the question is, what's going to happen next? And if there isn't regulators don't step in and do more to protect investors, we could pretty much assume that we'll just see another crypto bubble, and it'll all just build up again.
Perfect timing, just to say that as we're coming towards the end, and we have been touching on regulation, we got about 5 minutes just to kind of wrap up, you know, this succinctly, this whole massive issue. But I don't know, Carol, I don't know if you've got thoughts in terms of maybe just a couple or one or two policy points that you think are particularly pertinent. And I realise it's a holistic issue. So yeah.
Yeah, I looked at that link you sent me for the UK stablecoins from the Bank of England, but it says hardly anything. I mean, the MICA, the European ones are a little much. I mean, much more is in those proposals, and it's clear that they don't really quite understand that there are differences in different types of stablecoins. But for the very large ones, there's going to be a cap on trading, and the volume of transactions per day will be 200 million euros, no more, for Tether or for USDC. So I suppose what we'll see is a sort of fragmentation, so that instead of having a few very large cap ones, there'll be smaller ones that try to get under the radar, and they'll get around the regulations that way. But the main concern is the learning curve gets steeper and steeper, because we're playing catch up all the time with what's been happening on DeFi. I mean, I teach this stuff. Every year I have to change the course considerably. And this year in particular, I mean, there were things that have just been developed the last 6 months, 12 months that are really important for students and other people to understand. But if regulators haven't even got the basic background, which many of them don't, because there's so much money available if you go and work in, I mean, regulators don't pay very well, they're not going to have the people that have the right knowledge to take this on. That's what's happening in Europe and in the US. I mean, goodness me, you've got the SEC, you've got the CFTC, you've got the New York State Attorney, you've got, et cetera, et cetera. They just don't know who's going to be in charge of what. And this whole case against Ripple, is Ripple a security, is really a test case. According to the SEC, everything but, for some absurd reason, Bitcoin is a security. I mean, so whatever, maybe they don't want to regulate Bitcoin.
Brilliant, thank you, Carol. Amy, I don't know if you have any sort of additional, one or two, or stick to one. I should stop. One policy suggestion or regulatory suggestion that you see.
Well, just to reiterate the point that I made, unless the regulators step in and do more to protect investors, we're going to see all this just repeat over again. The bubble will reinflate, and then repop. And every time it pops, it just seems to, it just seems to be a bigger explosion. More people are getting hurt. Yeah. So
more retail people being brought in.
Yeah, absolutely.
Francis, yeah. Yes.
I think that, we are clearly going to see more and tougher regulation, and we will see some differences between regulatory regimes as well. And we will also see some jurisdictions that don't regulate, and that's where the offshores will all go. And so I think the prospects for having a Eurodollar style bubble are actually, with regulatory arbitrage, are quite substantial, and it's something that regulators should be on their guard about. We need better international cooperation of regulation where crypto is concerned, as we now have for banks to a great extent as a result of 2008, when that kind of regulatory arbitrage was a huge driver of the 2008 crash. We've got the same kind of thing developing with crypto, and I think regulators need to be on their guard, and they need to be cooperating to ensure that exchanges and platforms don't take advantage of differences between regulatory regimes in different countries.
Well, thank you all for your time today. As ever, it's a pleasure to speak to you.
Sid.
And yeah,
pleasure.
Really hope everyone watching has enjoyed, and look forward to the next panel. Thank you very much.
Okay, thank you. Bye-bye.
Okay, thanks. Bye.
Bye.